Hello, Market Rebels. Well, a question that new traders often have when they first learn about options is why are there so many strike prices? And it's a good question. You look at a certain month and there are going to be a ton of strike prices. And new traders often think, well, why would you need so many? You're just trying to take the right to buy or sell the shares. Shouldn't there just be one strike? Why do we have so many? Well, it's a good question, and there are very good reasons, so let's go find out. So let's start with some of the technical aspects of it for the option strike listings. Most of your exchanges work in a similar way, but whenever a new option expiration month is created, that the exchanges will always list an at-the-money option, that's a strike that equals the current stock price, plus at least one in the money and one out of the money strike. That's the very basic. At the money plus one in the money plus one out of the money. Now, sometimes you'll see more. You might see 2 or 3 in the monies and 2 or 3 out of the monies. And the range depends on the stock's price or the stock's volatility. Now, just because a stock starts with a certain range of strikes, there are 2 reasons why strikes can get added. Now, once they're added, they never get subtracted. But for any given month, throughout the option's life, you can certainly see additional strikes getting listed. So here's the basic protocol. If the stock closes above the highest strike or below the lowest strike, a new option strike is listed. That's the first reason, but there's a second one. You can also request strikes. So these are the 2 reasons that option strikes will get added, or at least could get added, throughout the option's life. So for instance, let's say that the stock is currently trading for 100 and we have a brand new option series that's being listed, brand new expiration. Well, at a minimum, you're going to see a 105 call, that's 1 strike out of the money, and you will see a 95 call, which is 1 strike in the money. That is the bare bones minimum. Now, by today's standards, that's going to be extremely rare to see only 3 strikes listed, but that will always be at least the minimum. But to make it simple, let's say that these are the 3 strikes that we're dealing with, but between now and the option's expiration, the stock closes, let's say above 105. Now, it's important that it closes there. It might trade up above there during the day, might go to 106 or 107, but it must close above 105. And if it does that, now the 105 is in the money call, and now a new one gets listed. Now you'll see the 110 call get listed. All right, so let's say that sometime before the expiration, the stock price actually falls, and now it closes below the lowest strike. So again, that's important that it closes there. And if it does, now the 105 call is out of the money, the 95 is out of the money, and a new in the money strike will get listed. So now we'll see the $90 call get listed. So that's the basic reason why strikes will get added, and that's why the list can grow. So right now we started out with a simple example where we just saw 3 strikes. But let's say it's a more volatile stock. What might happen now on the first day that a new expiration is listed? Well, instead of seeing 3 strikes, you might see this. You might see this right off the bat. Even though the stock is currently trading for 100 and hasn't moved, this is the first day the options are listed, you could see a fairly big list. But this is going to be for stocks that have more volatility. That is, the stock's price tends to jump around a lot. It could also be where you have stocks with a lot more interest in them. There's just a lot of news, a lot of interest, and so they will start to widen out these strikes. But the process is still the same. So in this example, if the stock ever closed above 125, then you would see the 130 call being listed. And conversely, if it ever closed below 75, then you would see the 70 call being listed. Now, it's also important to understand that for every single call option, there is a corresponding put option. So again, this is what we call the corresponding puts. So if there is a 125 call, there's absolutely going to be a 125 put. If there is a 90 put, there is absolutely going to be a 90 call, and so on. So that's the first reason why you might see a lot of different strikes and how they can change between the day that it's first listed and expiration. So let's now take a look at the second reason where you can request a strike. So for instance, the Chicago Board Options Exchange, or the CBOE, which is the largest options exchange in the world, you could actually call them to request new strikes. Now, in late 2020, they changed the rules somewhat, and now the CBOE only accepts requests from what are called trading permit holders, which are essentially brokers and others that have commercial business and licenses with the CBOE. But just really a matter of a different route you have to take. You can simply contact your broker to request different strikes. However, keep in mind that these strikes are added at the CBOE's discretion. But as long as they're somewhat in the realm of sensibility, you'll find that the CBOE will probably grant that request. Now, it's also important to understand that if you are requesting strikes that have a very large gap, let's say the highest strike is 120 and you want the 150s, the CBOE will fill in all of those missing gaps. So they would list the 125, the 130, and so on, and that way you don't have any glaring holes in these strikes. Now, it also used to be, way back, that if you did this, made a request for a strike, that you had to guarantee at least, let's say, 10 contracts before they would open these strikes. Not true anymore. All you have to do is request it, and in most cases, you will see those strikes get added. So here's a second reason why strike prices can get added to an expiration after the option is listed. Okay, let's go over to the E-Trade platform and take a look at some examples. So now we're into the E-Trade platform, and I'm going to start with a stock called Eagle Bank Corp, ticker EGBN, and I'm picking it because it's not a real widely followed stock. It is an optionable stock, which means it does have options trading on it, but it's also not a real expensive stock or a real volatile one. So take a look down here. We only have 4 expiration dates to choose from, and out of all of the strikes, the lowest is a 30 strike, and the highest is 80. So most platforms will box in or shade in the in-the-money options. Down here are the out-of-the-monies. But you can see it's just not a real big list of strikes. And you can also see that for every call on the left, there is a corresponding put on the right. But now let's find a different ticker, one that has a very wide following and has some volatility to it. Let's take a look at Microsoft. Now this is the same expiration date, but first off, notice how many different expirations are available. This is just because there's a lot more demand and a lot more interest in this stock. But for the same expiration, 15 days, take a look at the lowest strike, 120. Now the stock is at 336. So this is very, very deep in the money. Let's see what the highest strike is. Look at all of these strikes. Come all the way down here to the bottom, 475. That's just for 15 days until expiration. So that's about 40% out of the money. Probably not going to happen, but they still list these strikes regardless. Now you will also see that as you go out in time, as you look at longer dated expirations, because the stock has more time to drift, you're probably going to see a wider range of strikes. So again, for Microsoft, the highest is 475 and the lowest is 120. Well, watch what happens if we come out here to January of 23. So now we've got 442 days until expiration. Now the lowest is 105. See, it used to be 120, so we have a few more strikes in the money. 105, and the highest is now 490. See, it used to be 475. Now also, after certain stock prices, they will usually list them in 10-point increments, and that's what's happening here. But we still have a 490 as the highest strike. Okay, so those are some of the technicals on why there are a certain number of strikes when an option is first listed and how those strikes can change throughout time. But what's really important is how do you use the many different strikes? You have to understand as new traders that each strike is a tool and each has different characteristics. And so depending on your strategy, your outlook, your goals, you might choose different strikes. So for instance, here is a $100 call. Here's the expiration graph in black. As we always point out, there is a bend right there at our strike. This is the current graph in red, and this is simply showing you the profits and losses across various stock prices. And so, for instance, let's say that we've got the 100 call here, but maybe the stock is out here at 90. It's an out-of-the-money call, and there might be a very good reason for choosing this strike if we're looking for maybe some leverage. And that would make more sense as you get more involved with options trading and strategies. We could also consider the at-the-money. Maybe the stock is right here trading at the same level as the strike. That's an at-the-money option. This is where we might make use of what's called gamma, or the curvature, the acceleration of how quickly are these profits going to accelerate. That's a different strategy and therefore a different tool. At the other extreme, we might find this $100 call useful if we have the stock way up here at 115. This would be an in-the-money option, fairly deep in the money option, but it's behaving about like stock. And there might be a very good reason why we want this option to behave more like stock as opposed to a lottery ticket. But they can all have certain uses at certain times. So one of the main things to get from this video is you don't want to see, let's say, the at-the-money option as being the only available option that you should choose. I've heard traders say that, and they'll say, well, the only reason there's out of the monies or in the monies is because the stock used to trade there, but there's no reason to use them. You always use the at the money. That is simply false. All of these strikes, and all of those expirations for that matter, create different characteristics. And when you understand what those characteristics are and how to use them, that's when you're going to make your best use of the option strategies.